Hello, hello, hello. We are back with yet another video. And today we finally get into the topic of what is valuation, what do we mean by value, and I, for one, am super excited. I will try today to help develop an intuitive understanding of what the valuation process is and what value is. And we'll do this by taking a field trip to a marketplace for businesses. Exactly. This is a marketplace where you can actually buy businesses. Fake it till you make it, I guess. So, assume you have two businesses which have an equal amount of risk. This is a big assumption, but bear with me. We have the lucrative fertilizer manufacturer, and buying this business will get you a 20% return. On the other hand, you have the soft drink producer. Buying this business will get you a 15% return. Now, if you're a rational investor, the decision is quite straightforward, right? You get the fertilizer business because it offers a higher return for the given amount of risk, 5% higher to be exact. And this is a good way to start thinking about the opportunity cost because now I ask you another question. If somebody were to bring a third business into this, for example, an electricity producer, how much return would you want to purchase that business rather than the fertilizer manufacturer? Well, you'd want a return which is higher than 20%, right? And that is basically what we mean by opportunity cost. It is the return that would be required of an investment to make it a viable alternative to other investments with similar risk. This is just another way of looking at risk, which we did in a previous video, which I'm assuming you have watched because I am a narcissist. Opportunity cost is also sometimes referred to as the required return or the interest rate. Another way of thinking about opportunity cost is that the investor is basically saying to you that I want to give you my money, but you have to make it worth my while, right? So give me a decent return. And if your investment isn't giving a high enough return as compared to the alternatives, the investor won't come to you. Simple. Now that we've developed an understanding of the opportunity cost, we'll be heading towards a bank. And I'll also be referring to the opportunity cost as the required rate of return. Now, this bank offers a rate of 20%. I currently have 100 rupees which I want to invest. My holding period is of 1 year. In finance, we will refer to the amount that you currently have as the present value. As an investor, I would like to know what my 100 rupees will be in 1 year's time, which is my holding period, if I earn a yearly return of 20%. Now, this value in finance is called, no surprises there, the future value. And how do we get that future value? We use a process known as compounding. It may seem complex or complicated, but it is actually quite simple. Basically, you take your present value, you multiply it by 1 plus the rate of return raised to the power of your holding period. In our case, we have a present value of 100 rupees. We multiply it by 1 plus 0.20, which is just another way of writing 20%, and we raise it to the power of 1, which is our holding period. Now, if our holding period was of 2 years, we would write 2. And if it was for 3 years, we would write 3. Simple. Following this simple formula, we get 120 rupees, which means that my 100 rupees in 1 year's time will be 120 if I earn a rate of 20% during that period. Now let's move to Excel to see some variations and finally pinpoint what is valuation. Okay, we're almost at the end. We now know what the present value is, what the future value is, and that through compounding, we can get the future value of our investment if we have the holding period and the rate of return. Now, we did the compounding for a single period in the slides. So we had 100 rupees at the start. We multiplied it by 1 plus 20%, which is our rate of return, and we got 120 rupees. Now, this ending period value that you have at the end of year one is the beginning period value for year two. And if you continue to hold the investment for year two, your value at the end of year two will be 120 multiplied by 1 plus 20%, which is 144. Again, if we do this for another year, the starting value at year three will be 144 rupees multiplied by 1 plus 20% by the end of year 3, we get a value of 172.8 rupees. Now, in finance textbooks and articles, a lot of times compounding is written like this: 100 into 1 plus 20% raised to the power 3, or 100 into 1 plus 20% into 1 plus 20% into 1 plus 20%. And all of these things basically are a way of saying that you take 100 rupees, you multiply it by 1 plus the rate of return, and then you keep doing this process that we did above for however many number of periods you have. And that is all compounding is. Now, the question is, can we do the opposite? That if we have a value at year 3 end, can we guess what that value is now at time 0 or the present? We actually can do that. And that is what we in finance call discounting. So imagine in year 3, by the end of it, you have 172.8 rupees. In compounding, we multiplied, whereas in discounting, we will divide the future value by 1 plus r raised to the power of the holding period. So we take 172.8, which is the value at year end for year 3, we divide it and we get 144, which will be the beginning value of our amount at the start of year 3. We do this for year 2 and we get a value of 120 rupees. We basically take 144, which was the ending value at year 2, we divide it by 1 plus 20%, and we get 120 rupees at the beginning of year 2. We keep doing that and we get back to our original value of 100 rupees, which is basically the amount we have today as of now. And congratulations, this is basically what valuation is. Valuation in finance is taking a series of cash flows which are in the future and discounting them to today so that you have a value for a certain asset. One last thing before we move on. Just like compounding can be written in different ways, we can do the same with discounting. Just a second here. Discounting can be referred to as 172.8 divided by 1 plus 20% raised to the power 3, or whatever holding period you have. 3 is just the holding period that we have in our example, or in this longer form. Now, we just said that valuation is taking a series of cash flows which are in the future and bringing them back to the present time, and we get a value. But why do we do this? We do this to compare the market price, which, for example, as we started the video with, we had two businesses, the lucrative fertilizer manufacturer and the bottler. So, for example, the fertilizer business is being sold at a market price of rupees 500, whereas the soft drink manufacturer is being sold at rupees 550. The question is, should you or should you not buy both of these? Now, That is where valuation comes in. Okay, so we're back in Excel. We know that the lucrative fertilizer manufacturer is offering us 400 rupees income at year one end, whereas the soft drink producer is giving us 750 rupees. The holding period for both of these businesses will be 1 year, and the discount rate for both of them will be 20%, which is the opportunity cost or our required return. Now, they're currently being priced by the market at rupees 500 for the manufacturer and 550 for the soft drink producer. If we discount the cash flow, let's see what we get. We do this simply by taking the income, dividing it by 1 plus the discount rate raised to the power of the holding period. We do this for both of them. Now, look, the value of the fertilizer manufacturer through this method is 330 rupees, whereas the market is pricing it at 400 rupees. This means that the asset is overvalued by the market. Now, the soft drink producer is being valued at a price of rupees 625, whereas the market price is 550 rupees. This means that it is undervalued by the market. And in these cases, what should we do? Well, if your asset is undervalued, you buy it, or if you've already bought it, you hold on to it so that it appreciates in value. Whereas if you have an asset which is overvalued, as in the market price is greater than the value that you're getting, you either don't buy it, or if you are already in possession of it, you sell it. And that is the gist of valuation. Sum it up, the main question that valuation answers is the market price greater than, less than, or equal to the value? If it is greater than the value, you sell. If it is less than the value, you buy. Now, a discounted cash flow is the only way you can value a company. No, you can also use relative valuation, a method which is fairly popular in Pakistan. Another name for this is the multiples approach, where you use something like the price to earnings ratio and the earnings per share to get the share price of the company. However, this certain playlist will be focused on discounted cash flows. There are two main methodologies used in the discounted cash flow approach. One is where you take the operating free cash flows of the company and then discount them. You can apply this to mostly any company. And the other one is the dividend discount model, where you take the dividend and then you discount it. This approach is used more for companies which pay a stable dividend and are more at their maturation phase as compared to a company which is in the growth stage. That's all from our side. Our next video will be on the dividend discount model. If you enjoy videos like these, where we break down financial concepts and explain them in an easy way, YMS Classrooms is the place for you. Subscribe and stay tuned for more.